and gentlemen, thank you for standing by, and welcome to Jeld-Wen Holdings Inc. Fourth Quarter 2020 Earnings Call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during this session, you will need to press star and the number 1 on your telephone keypad. If you require any other further assistance, please press star 0. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your speaker today, Chris Teachout, Director of Investor Relations. Please go ahead.
Thank you. Good morning, everyone. We issued our earnings press release this morning and posted a slide presentation to the Investor Relations portion of our website, which we will be referencing during this call. I'm joined today by Gary Michel, our CEO, and John Linker, our CFO. Before we begin, I would like to remind everyone that during this call, we will make certain statements that constitute forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. These statements are subject to a variety of risks and uncertainties, including those set forth in our earnings release and provided in our Forms 10-K and 10-Q filed with the SEC. Jeld-Wen does not undertake any duty to update forward-looking statements, including the guidance we are providing with respect to certain expectations for future results or statements regarding the expected outcome of pending litigation. Additionally, during today's call, we will discuss non-GAAP measures which we believe can be useful in evaluating our performance. The presentation of this additional information should not be considered in isolation or as a substitute for results prepared in accordance with GAAP. A reconciliation of these non-GAAP measures to the most directly comparable financial measure calculated under GAAP can be found on our earnings release and in the appendix to this presentation. I would now like to turn the call over to Gary.
Thanks, Chris. Good morning, everyone, and thank you for joining us today. Over the past 2 years, we have deployed the strategic foundation to propel Jeld-Wen to premier performance. We are executing a disciplined plan to accelerate organic growth, expand margin, and improve cash flow while effectively allocating capital to optimize shareholder returns. And we're making good progress in each of these areas. The underpinning of our strategy deployment is our business operating system, JEM, the Jeld-Wen Excellence Model. JEM is the systematic way that our people work within the company to deliver our strategy globally. This holistic approach is anchored in the very essence of a lean problem-solving culture, the practice of continuous improvement, development and respect for people, and the identification and elimination of waste. While still in the early stages, we are seeing consistent outperformance in the areas where JEM has been deployed, and we are seeing progress in the strategic growth drivers. In previous calls, we've highlighted our commercial work focused on customer and channel segmentation, innovation, and unleashing the vast opportunities to expand distribution of Jeld-Wen products and services across geographies and channels. This combination of commercial strategies and disciplined price realization is delivering market share gains and margin expansion. The disciplined approach of using price to offset inflation has now led to 9 consecutive quarters of favorable price cost. Likewise, we've made significant progress in our footprint rationalization and modernization initiatives, having completed projects that represent the first third of our $100 million targeted annual savings. Execution is now underway on the next phase of the program and associated savings. You'll recall that the rationalization and modernization programs reduce rooftops and costs while adding manufacturing capacity and enhancing the ability to serve customers. Across the rest of our sites, JEM is driving productivity savings through more efficient labor utilization, material consumption, and sourcing savings. In 2020, we made great progress on these strategic levers while also navigating the unprecedented challenges of the year, including the effects of the pandemic and other unanticipated events, including severe weather and natural disasters. The impact of these events was felt throughout the year, including in the fourth quarter. These effects included increased absenteeism, supply chain disruptions, and unforeseen government lockdowns. Nonetheless, with safety always at the forefront, our associates found a way to deliver for our customers, our communities, and our shareholders. I want to extend a sincere thank you to all our associates for helping us achieve these results through such uncertain times. In the fourth quarter, we delivered both core growth and margin expansion. Total revenue increased 7.7% versus prior year, and adjusted EBITDA grew 29.4%. Core revenue grew 5% versus last year, contributing to 190 basis points of core margin expansion. This was the best quarter of year-over-year core revenue growth since 2017, led by North America and Europe, and the first quarter of core revenue growth for Australasia since the second quarter of 2018. All three segments delivered sequential improvements in volume growth and significant margin expansion versus prior year. We continue to benefit from favorable price and, while still a headwind in Q4, signs of improving product and channel mix. In addition to these positive revenue impacts on margin, each segment delivered positive net productivity, further expanding our adjusted EBITDA improvement. Specifically, we saw a 300 basis point margin expansion in North America, 330 basis point margin expansion in Europe, and 150 basis point margin expansion in Australasia. The execution of our commercial strategies and the benefits of JEM are showing through. For the full year, revenue declined 1.3%, clearly below our expectations as we entered the year. That being said, the deliberate actions taken by our teams, coupled with productivity benefits from footprint actions and the deployment of JEM, were able to offset the impact of the pandemic to deliver 100 basis points of core margin expansion. In addition to implementing cost savings, preserving cash, and managing working capital, we also overcame the cost to ensure safe working environments for all of our associates, increased absenteeism in certain operations, the effects of mandated governmental closures, and temporary changes in product and channel mix. This strong earnings performance, continued focus on working capital improvements, and prudent capital allocation delivered free cash flow of $258.8 million, a 55% increase and a record for Jeld-Wen. Further demonstrating our quality of earnings and the strength of our balance sheet, we reduced net debt leverage to 2.3 times, the lowest since the IPO 4 years ago. And with record liquidity of approximately $1.1 billion, we have flexibility as we evaluate strategic alternatives to further enhance shareholder value. John will provide additional commentary on our financial performance, and I will provide some thoughts on 2021 in a few minutes. First, I will share some thoughts on our markets and key drivers for each segment. For North America, housing fundamentals remain supportive. We expect the recent robust increase in housing starts to continue and perhaps accelerate as strong new home orders from previous quarters turn to starts. Completion activity of these starts may lag due to builder supply constraints, including labor and other building product availability. We expect overall demand for R&R activity to grow by low single digits, favoring larger pro-driven projects over DIY. The pricing actions we implemented in late 2020 are holding, and we expect solid realization to more than offset increasing inflation and tariff headwinds expected during the first half of the year. For Europe, we expect markets to be somewhat flat for the full year. For the first half of 2021, our end markets in Europe are open and healthy across new construction, project, and R&R. However, we see potential for demand to moderate later in the year. Market share gains and continued momentum, including sequential improvements in price and mix, will extend performance in the segment. For Australasia, particularly Australia, residential new construction markets continue to be challenging and have yet to recover. We saw signs of stabilization during the fourth quarter with accelerating single-family new construction permits. We expect some ongoing improvement from the benefit of government stimulus programs directed at both new home construction and remodel activity. However, a significant portion of Australia's new housing demand, comes from immigration, which has been halted due to COVID-19. The government has yet to set a date for this to resume. Repair and remodel demand is also expected to be challenged. However, we expect to offset some of this weakness through additional market share gains. I'm optimistic about the outlook in each of our markets for 2021, particularly housing fundamentals in North America, European market dynamics and stabilization, and some improvements in Australia. However, the foundation for our performance has been and will be based on continuing to deliver significant margin expansion and growth through our disciplined deployment of JEM, the execution of the rationalization and modernization programs, and the benefits of commercial excellence, including innovation, segmentation, and price. John will now provide a detailed review of our financial performance for the fourth quarter and full year 2020.
Thanks, Gary, and good morning, everyone. I'll start on page 10. Our fourth quarter financial results demonstrate continued execution in a challenging operating environment as we delivered meaningful improvements in revenue, earnings, margins, cash flow, and on the balance sheet. This strong performance is a direct result of running our playbook consistently over multiple quarters, focusing on our strategy and the continued disciplined deployment of JEM, our business operating system. Fourth quarter net revenue increased 7.7% to $1.2 billion. The increase was driven primarily by an increase in core revenue, as well as a favorable impact from foreign exchange. Notably, all three segments delivered core revenue growth as volume mix improved sequentially from the third quarter. Adjusted EBITDA margin expanded 160 basis points in the quarter to 10.0%, while core adjusted EBITDA margin, which excludes the impact of foreign exchange and any recent acquisitions, expanded 190 basis points, our third consecutive quarter of margin expansion. The combination of price realization, execution of our structural cost reduction programs, and productivity tailwinds from JEM initiatives all contributed to the strong margin performance. Page 11 provides detail of our revenue drivers for the fourth quarter. Our consolidated core revenue increased 5%, comprised of a 4% benefit from pricing and a 1% contribution from volume mix. Please move to page 12, where I'll take you through the segment performance in more detail. Net revenue in North America for the fourth quarter increased 4.5%, driven by a 6% increase in pricing, partially offset by a 1% headwind from volume mix. While the 1% headwind in volume mix is a sequential improvement from the third quarter, this is a lagging indicator that does not fully tell the story of a healthy demand backdrop in North America. So I'd like to spend a moment on the dynamics by product and channel. North America demand in the quarter was generally quite strong. Unit volumes increased sequentially in most product areas, and order activity remained healthy as well, leading to strong book-to-bill and healthy backlogs. Unfortunately, COVID-related absenteeism in our manufacturing operations stepped up significantly in the quarter, which impacted our staffing levels and throughput capacity in key plants. As a result of the absenteeism, we faced volume headwinds on revenue in certain products and plants, even though the underlying orders were healthy. Mix also remained a revenue headwind as well in North America, primarily because inventories of stock SKUs at our retail channel partners remained below both their target levels as well as below prior year. As we worked with our retail partners in the quarter to restore their inventories to targeted levels, order activity was weighted towards lower priced stock SKUs, and therefore we saw reduced activity in higher priced special order SKUs and custom orders. In terms of how these dynamics impacted our North America channel results, in our U.S. retail, repair, and remodel channel, revenue increased approximately 10% compared to prior year, with growth in both doors and windows. In our U.S. traditional wholesale channel, revenue declined mid-single digits due to the impact of absenteeism and COVID restrictions. In our U.S. door distribution business, revenue declined mid-single digits. Demand in this channel was strong. However, our ability to meet the demand was constrained due to new COVID restrictions in California, where we have several large distribution locations, and generally higher absenteeism across our network. All other channels in North America, including Canada, BPI windows, and other products, netted to revenue growth of approximately 10%. Even with the absenteeism and mix headwinds we faced in the quarter, revenue growth compared to prior year accelerated meaningfully in the month of December, so our exit rate was better than the full quarter. In January, the strong revenue performance continued in North America. Given these recent trends, we feel good about the setup for North America revenue growth for full year 2021, noting that first quarter comps will be impacted by fewer shipping days due to our 4-4-5 accounting calendar. North America adjusted EBITDA margin expanded 300 basis points to 12.4%, driven by strong pricing and net productivity, partially offset by the mix impact that I just discussed. The margin improvement was nicely distributed across product lines, with healthy margin expansion across doors, windows, and Canada. Europe revenue increased 14.9% overall and 8% excluding the impact of foreign exchange. Core revenue growth was comprised of 6% volume mix and 2% pricing. Similar to last quarter, we believe our volume performance exceeded market growth, demonstrated by mid-teens local currency revenue growth in Scandinavia and high single-digit revenue growth in Central Europe. For the sixth consecutive quarter, Europe delivered core margin improvement with an increase of 330 basis points year over year from strong productivity, cost reduction actions, and leverage on volume growth. Australasia revenue in the quarter increased 7.6% overall and 2% in local currency versus prior year. The revenue performance benefited from the reopening of Victoria from the 112-day COVID lockdown, the impact of government stimulus, and profitable share gain. This is the first quarter of core revenue growth in Australia since the second quarter of 2018 due to the ongoing housing market headwinds. We're pleased with the fourth quarter revenue performance and continue to see near-term improvements in early 2021 as a result of the government stimulus programs. That said, demand visibility for full year 21 remains quite limited in Australia, given the immigration restrictions that are still in place, which is a meaningful driver of population growth and housing demand. On the back of this improved revenue performance, our Australasia segment delivered margin expansion of 150 basis points from solid productivity and volume leverage. Coming back to our global consolidated results, I'd like to comment on input costs. As we anticipated, fourth quarter material cost inflation and freight rates did accelerate year over year and sequentially from the third quarter. However, price more than offset these increases, so there was no significant impact on margin. Looking into early 2021, we expect inflation and import duties to continue to increase, particularly in the first half of the year. Also, as a result of the tight labor market and COVID-related absenteeism, labor inflation in North America is an area of increasing concern. But despite these potential headwinds, we will continue to use price as needed to offset inflation to ensure that we still deliver on our goals for continued margin expansion in 2021. SG&A increased compared to prior year, primarily due to charges taken for legacy litigation and environmental matters and certain variable compensation accruals, partially offset by cost reductions and other ongoing reductions in our fixed cost structure. One item to note on taxes in the quarter. As you may recall, our book tax rate has been negatively impacted for the last 2 years due to the GILTI provisions of U.S. tax reform. Late in 2020, the U.S. Treasury finalized regulations for a high tax exclusion option for GILTI, retroactive for 2018 and 2019. We elected the newly issued high tax exclusion under GILTI in the fourth quarter, which allowed us to restore certain net operating loss carryforwards to our balance sheet that had previously been utilized as a result of GILTI. After consideration of additional tax planning measures, we were able to restore approximately $100 million of net operating loss carryforwards, which will have a favorable impact on our cash taxes in the future. We recorded a one-time P&L benefit of approximately $10.8 million in the fourth quarter to reflect the restoration of these NOLs, offset by the net reduction of certain deferred tax assets related to foreign tax credit carryforwards from which we will no longer be able to benefit. Please turn to page 13, where you can see the details of our strong cash flow performance in 2020, which led to a reduction in net leverage to 2.3 times, the lowest point since the IPO. Operating cash flow increased 17% compared to prior year, and free cash flow increased 55%. While our 2020 operating cash flow did benefit from certain COVID-related assistance programs, such as temporary payroll tax deferrals, most of which will be repaid in 2021, overall, the 2020 improvement was driven by stronger, high-quality earnings and more efficient working capital utilization. Page 14 highlights the longer-term trend data on both cash flow and net leverage. As you can see, we have generated sustained improvements in free cash flow for the last few years, which has benefited our balance sheet and capital allocation opportunities. And lastly, on page 15, I'll highlight our current liquidity of $1.1 billion. This level of liquidity is the highest ever for the company and gives us flexibility to create shareholder value during these uncertain times. With that, I'll turn it back over to Gary, who will provide closing comments. Gary?
Thanks, John. Despite the effects of the pandemic and other unique headwinds last year, we delivered strong financial performance through disciplined deployment of our operating system, GEM, and the strategies we set out to expand our capabilities to serve our customers. The momentum in growth and margin expansion in Q4 and the strength of our balance sheet, coupled with favorable market conditions, sets us up nicely to deliver in 2021. We remain optimistic about the outlook in each of our markets, particularly strong housing fundamentals in North America, healthy near-term order books in our European markets, and some signs of demand improvement for residential construction in Australia. That being said, our performance has been and will be based on continuing to deliver margin expansion and growth through our disciplined deployment of GEM, the execution of the rationalization and modernization programs, and the benefits of commercial excellence, including innovation, segmentation, and price. All in, we expect total consolidated revenue growth between 4% and 7% for 2021, and we expect to deliver full-year adjusted EBITDA in the range of $480 to $520 million. This continued margin expansion is a result of volume growth and our strong pipeline of productivity and cost projects, including modernization and rationalization savings and the benefits of price increases already deployed to offset accelerating inflation and tariffs. As we conclude, I'd like to highlight that the strong results we reported today are a direct result of the strategic work, persistence, and tenacity of the talented people at Jeld-Wen and representative of the unique culture we're building. Our management team has been deliberate and effective in building the foundation to deliver sustainable premier performance for our customers and our shareholders. Momentum is strong, and we are excited about the year ahead as we continue to transform Jeld-Wen into a premier building products company. Thank you for your continued interest in Jeld-Wen and for joining us this morning. John and I will now be happy to take your questions.
Thank you. At this time, if anybody would like to ask a question, please press star 1 on your telephone keypad. Your first question comes from Matthew Bouley from Barclays. Your line is open.
Good morning, everyone. Thanks for taking the questions. I want to start out with a question on the price cost side. Gary, you highlighted the commercial efforts have, done a nice job keeping price cost favorable for several quarters in a row here. So I guess to the extent inflation is an increasingly greater headwind in the first half of this year, as you suggest, have you taken enough price across the segments to kind of maintain this recent trend of price cost positive, or should we think it's more of neutral this year given inflation? Thank you.
Thanks for the question, Matt. I think that what we've been fortunate in that we've had really disciplined pricing in the markets, primarily here in North America, but we've seen price benefits all across the world in all the markets that we've been in, and we've been able to take some outsized price increases, particularly in doors in North America, and then followed with kind of the goings on in windows. We've been able to see mid to late last year some good action there. We are seeing some inflation, in the first half, as we mentioned. We are watching it very, very closely, and we do believe that we still have opportunities to put more price out there. That's a lever that we can pull in order to continue to maintain. Our strategy has always been that price, actually more than offset inflation. So it's something that we watch quite a bit. The work that we talked about really over the last kind of year and a half, 2 years around segmentation and of our customer base and of our product base, it's really played out, and that's where we're seeing a lot of this outside margin expansion as a benefit of price. So we feel pretty good about our ability to pull that lever again.
And Matt, it's John. I'll just add on. I'd say that based off what we have in place today in terms of pricing that we've implemented and negotiated with our customer base, and based off of where inflation sits today, noting that inflation is extraordinarily dynamic right now. I mean, we're just seeing big fluctuations sort of as the weeks go by, but based off of what we have in place already and what we know inflation is coming, yes, price cost will be a tailwind for the full year, just less of a tailwind than it was in 2020.
Got it. Okay, that's helpful. Second one on production rates, I guess focusing on North America. I mean, obviously Windows is sort of thought of as a product in short supply these days. It sounds like you also had some challenges in the door distribution business. Can you talk through kind of the ability to ramp production here? Does your revenue guidance assume you're able to sort of knock down this backlog that's building, and just what type of costs might be associated with ramping production here? Thank you.
Yeah, so when we look at production, it's kind of to unpack kind of really three pieces of that business. I'd say earlier on last year, we saw the kind of absenteeism COVID effect affecting the Windows business a little bit more than the other businesses. That has changed and kind of flip-flopped. We're actually in a really good position on the Windows side. I know that there's a lot of demand for Windows right now, and we feel that we're in a position on our production side on Windows to actually, and we are seeing commitments and share pickup as we're able to deliver more steadily there. So that story of improving the Windows production has really, that's kind of in our, kind of in the rearview mirror for us, and we're actually seeing some good performance there. So pretty excited about Windows. On the door distribution side and doors in general, we saw some more absenteeism. That's where the absenteeism actually kind of hit us in the fourth quarter. We are obviously doing all that we can to ensure that we have the folks that we need in our plants to operate and to build that down. We are working that down. Obviously, there's some weather issues right now in some of those areas as well that we're seeing across the country. But we continue to work that every single day, and the kind of the delivered actions and tenacity of our people to make sure that we're able to produce for our customers is something that we're very, very focused on. We do believe that we've been gaining share. We'll continue to do that. But one of the places where we got hit really the most was kind of in that California region, door distribution area. So we'll just continue to watch that.
Okay. Thank you, Gary. Thanks, John.
And your next question will come from John Lovallo from Bank of America. Your line is open.
Hey guys, thank you for taking my questions as well here. Maybe just starting off with SG&A, a little over 15% as a percentage of sales, above what we were looking for, and I think about 100 basis points higher year over year. Can you just help us, what some of the drivers were of that increase, and was that tied to the absenteeism, or were there other factors?
Yeah, I'd say there are a couple of things in the fourth quarter that did impact us that were sort of one-offs. We did have some additional litigation and legacy accruals that we had to make that were non-operating and excluded from adjusted EBITDA. There was some variable compensation true-ups in the fourth quarter, and also a bit of additional expense related to things like employees going back to a doctor for health claims, things that had been deferred earlier in the year, and seeing some catch up there. So I wouldn't say it was anything sort of structural that changed, John, in terms of the spend in the fourth quarter, just that it's kind of the timing of when things sort of hit us as we exited the year.
Okay, gotcha, understood. And then I think there was a comment made about European demand in general, and the possibility that that might moderate in the second half of the year. Was that comment related to more than the comps? Was that just structural demand might moderate? And if so, can you help us understand why that might be?
I think that the nature of that comment is, right now, you saw there in the fourth quarter, we had some pretty nice growth, as Gary called out, in certain areas of Europe. The order books look pretty good here in the first quarter, both on project, commercial business as well as residential. I think the concern and the lack of visibility that we have is, if and when sort of COVID does stabilize and consumer spending shifts away from R&R and home, and consumers start to think about other avenues for their dollars or their euros, travel or what have you, that could be potentially a moderation on some of the near-term demand. So it's not anything structural that we're seeing in terms of the market's weakening. It's just sort of a lack of clarity on exactly what's going to happen. If you take a step back, a lot of these European markets we're in are not overly healthy from an economic standpoint. There's higher unemployment. There's kind of low GDP. So I think you're just hearing a bit of cautiousness from us as we do have near-term visibility that's pretty good, but sort of back half of the year, there's a bit of a question mark on what that could look like.
Makes sense. Thank you, guys.
And your next question will come from Phil Ng from Jefferies. Your line is open.
Congrats on a solid quarter. Your volumes in North America were down about 1% in the fourth quarter. Appreciating you're dealing with some absenteeism. How are your orders tracking? And just given your view on North America resi, what type of organic volume growth do you anticipate this year?
So I'll start with that. The actual demand for product, even in the fourth quarter, was pretty strong in North America. Really that decline was purely based on the absenteeism and a little bit of mix for the quarter. When we think about what we're seeing strong demand and strong growth actually in retail R&R. We've seen some strong growth in some of our other businesses, including Canada, our VPI commercial business, and some other products. Really that absenteeism that we talked about in door distribution and some related to our U.S. traditional door channel is really the effect there. So we still have pretty strong backlogs, still pretty strong demand coming in North America, and still feel pretty good about our growth rates going forward there.
Yeah, so I just say, I mentioned the exit rate on the prepared remarks. Revenue growth in North America in the month of December was about 10% up over prior year. January is a bit of a tough comp because of the shipping days issue, so it's not exactly comparable, but I'd say the trajectory was similar. And year over year, sitting here in the first quarter, North America backlog, we're a fairly short cycle business, so we kind of think about it more as open orders as opposed to true backlog. But open orders are up fairly significantly versus the same time last year. So if we can sort of make sure we have stable manufacturing platform and get the absenteeism issues sort of worked out, I think we're teed up quite nicely for an acceleration in North America volume growth this year and as the year progresses.
And Gary and John, do you guys have a better sense on when you think you'll get the operations in a good spot to kind of capitalize on all this growth? It certainly sounds very encouraging.
Yeah, we feel, we watch it every day, obviously, but we've been taking some action to make sure that we're able to operate, obviously, in all of our plants. Absenteeism has kind of been the storyline for the last, quarter or two, just related to where the pandemic shifts are more, and a little bit on shutdown, obviously in California, where we've got operations. So we've been either overhiring or taking action to make sure that we schedule our plants around our ability to have people there. So we feel like we're keeping up with it fairly well. We have outages here and there that we work on, but we try to make sure that it doesn't affect our performance for our customers. And it's like I said, it's one of the benefits of the work that we have been doing for the last really few years on GEM. Primarily the benefits of that business operating system, the way that we operate. We know how many people we need to have. We know what the cycle times are. We have playbooks for different capabilities. So we may be operating at a lower playbook than we'd like to for the demand, but it's one that we know that we can get quality product out consistently with the type of labor picture that we have in any particular plant.
That's great. That's really great progress, Gary. And can I squeeze one more in? Just given the tightness you're seeing in the windows market in North America, do you expect to kind of recapture some of the share? And given some of the challenges you've seen in the last few years, profitability did take a step back. So is there any way to kind of help level set us where profitability could shake out this year versus maybe a few years back where margins were a little higher? Thanks a lot, guys. Appreciate it.
Yeah, so we've made some great progress in the windows business on the operations side. As you know, we stepped back a little bit on, we might have stepped back a little bit on share, but we've improved our margins fairly consistently and our throughput consistently. There is tightness in the market now. There's high demand for windows, and while we're seeing kind of the industry lead times kind of moving out, we're actually, still very commercially competitive. In fact, very, very close to what our traditional lead times have been on windows, which is turning into our ability to recapture share and recapture accounts that we might have lost, 18, 24 months ago, based on operational issues then. So the GEM work that we've been doing on windows has kind of caught up. And is performing very, very nicely. So it's leading to that margin expansion as well as the opportunity for share.
Yeah, and just on the margin side, 18 months ago, obviously we had some margin headwinds in the North America window business. We've now, I think, 3 quarters in a row had some pretty strong margin improvement in that business. The fourth quarter was up, 280 basis points, 300 basis points, something in that area in North America windows. So still not back to where we think the business is capable of from a margin standpoint, but the trajectory of operational improvements and margin improvements are certainly heading in the right direction.
All right, thanks a lot.
And your next question will come from Tim Wojs from Baird. Your line is open.
Hey, everybody. Good morning. Nice to see the progress. On margins, maybe just the first question I had, how should we think about margin expansion as we kind of walk through the year? I think the comps for margins are maybe a little bit easier in the first half, but you also have some inflation, and then the comps get a little tougher in the second half. So just trying to better understand how we should think about margin phasing for the year overall.
Yeah, I think so your comments are correct. The inflation is weighted towards the first half of the year, and if you think about sort of the phasing of when the price is going in that we've negotiated, we're not necessarily going to get a full quarter in the first quarter of some of the channel price increases that we've put into place in terms of offsetting this stepped up level of inflation. So price costs will be less of a tailwind in here in Q1. Overall, I'd say we do expect margin improvement in every quarter this year. We certainly feel like we've got the plans in place and the visibility to get there, both from price and volume, and then on the productivity side as well. So I think that the first quarter, while it is an easy comp versus prior year, it'll probably be the lowest margin improvement of the full year, just given that price cost and when we're getting hit with the inflation and tariffs, but should see that accelerate throughout the year.
So Tim, the beauty of our